Welcome to an Introduction to Accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. For further information about Parkbench Tutors, please visit parkbenchtutors.com. This short podcast is an introduction to the cash flow statement. In this podcast, you will learn what the cash flow statement contains and how it is derived. A cash flow statement will show the movement of cash over a stated period of time. This will be the same period of time as the income statement, so it will be the accounting period. It will indicate the effects of the movement of cash on different activities of the business. As an illustration, consider each of these transactions and determine whether the cash balance has altered. While some of these transactions directly affected the cash balance, others did not. Purchases and sales on credit will not affect the cash balances until payment is made or received. When we considered the balance sheet and the income statement, we made the point that we follow accounting standards that use accrual accounting. This means that the figure reported on the income statement as profit does not equal a sum in cash. In order to find out what is happening with cash flow, we are going to require more information. Any sales made on credit where cash has not been received may be a part of profit, but there is no cash until payment is received. Similarly, expenses incurred will not affect cash until they are actually paid. Take a glance at this business, where sales revenue has increased over the last year. However, a second look tells you that trade receivables increased by the same amount. The cash flow has not improved from this activity over the year. Many businesses do fail, not from their inability to make sales, but from their inability to collect the cash from sales within a reasonable period. Under international accounting standards, a cash flow statement is a requirement in reporting for business. It is made up of three sections. The first, summarizing cash flow from operating activities. The second, showing cash flow from investing activities. And the third, showing cash flow from financing activities. We have shown a summary here. Cash flows from the operating, investing, and financing activities are added or subtracted if there is an outflow of cash, to give the net increase or decrease in cash and cash equivalents over the period. You will have noticed a new term here, cash equivalent. A cash equivalent is a short-term, highly liquid investment. It can readily be converted to a known amount of cash. The risk of a change in value is considered to be insignificant. A bank deposit for a temporary surplus of cash is a cash equivalent. Shares held in another business are not cash equivalents, since the amount they might realize in sale is not known precisely. There are two methods of calculating cash flow from operating activities. The first is by a restatement of the income statement to show cash flow, and this is called the direct method. The second by adjustment of the figure for net profit for the effect of cash. This is called the indirect method and is the most frequently used method. Here is an example of use of the direct method for an entity. Starting with all cash receipts from customers, £8,500, we subtract payments to suppliers, employees, and for administrative and other expenses, leaving a figure of £3,000 as cash generated from operations. We are not quite finished yet. Now we need to subtract amounts for any interest and taxes paid. We are left with £2,000. Which represents the net cash inflow from operating activity. The process is shown here in a chart form. One thing that you should note is that to determine the cash paid to suppliers and for expenses, and to determine cash receipts, requires an analysis of the cash accounts. The indirect method is usually chosen because it makes use of existing information from the other financial statements. The procedure for the operating activities is to adjust operating profit for non-cash items, then for changes in current assets and liabilities, and finally for other cash flows. So, the first is for non-cash items. We add back in depreciation. Then we either add or subtract the changes to current assets. This will affect inventories, trade receivables, and trade payables. Finally, subtract interest paid, corporation tax, and dividends. Depreciation is a non-cash expense. There has been no actual payment of cash to arrive at this figure, so we need to add it back in to the operating profit. If we consider inventory, the increase or decrease is obtained by considering the figure at year end and comparing it to the figure at the start of the year, which will be the ending figure of the previous year. If inventory has increased, that must represent a cash outflow, since cash was used to purchase inventory. So for an increase in inventory, we subtract the amount to decrease cash flow. If inventory had decreased, we would do the opposite. If trade receivables increased, this means we collected less cash, so we deduct the increase. On the other hand, a decrease in trade receivables means more cash collected, so we add this back in. Similarly, adjustments are needed for trade payables. The determination of cash flow for investing activities is easier. If a non-current asset is sold, then there is an inflow of cash. If a non-current asset is bought, there is an outflow of cash. Non-current assets include property, plant and equipment, any investments purchased as assets, and intangible asset purchases and sales. Financing activities include the issue of shares, which will be a cash receipt, and redemption of shares, which will be a payment or cash outflow. Under IAS 7, dividends paid are reported here. Whilst the income statement shows profit for the period, and so is concerned with explaining the changes in equity that have taken place, the cash flow statement does something different. The cash flow statement explains the changes in cash that have taken place over the period. These changes relate to activities concerning operating, investing, and financing. So the cash flow statement is explaining change in cash and cash equivalents. In the next podcast, we shall work through an example to show how the indirect method is used. This ends our first podcast on cash flows, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For further information on Parkbench Tutors, please visit parkbenchtutors.com.